Join me for the Parrot Report.
Information presented on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming. Now on Sky News Business, this is Your Money, Your Call.
How cool is this? Welcome back to Your Money, Your Call. We've been off for a couple of weeks. I'm Mark Todd from the NAB, and I'm joined today by Dan Miles from Innova Asset Management. We have Greg Cooper. He's the CEO of Schroders. They're here to answer any of your questions, so feel free to call us. 1300 30 34 35. The email yourmoney@skynews.com.au. And to all the people that have emailed and all the different platforms, I've missed you as well. So, gentlemen, welcome.
Thanks,
I'll start with you, Greg. How is life at Schroders? You're the CEO of Schroders, so what's been happening in the world of the fund management?
Yeah, look, it's been an interesting sort of couple of months. We've seen a bit of a surge in LICs, LITs coming to market. You know, a big rise, I think, in terms of passive flows across the market, which has some interesting implications for market when you start seeing a lot of flows going into passive vehicles. More generally, though, you know, from an investment return point of view, which is what really matters, it's been a pretty benign environment, as we know. And I suppose, you know, big part of what we'll talk about this evening, but is the complacency that seems to be embedded in markets. And while that's led to reasonably good returns over the course of this year and certainly over the last few months, you know, we'd probably ask a few questions about the sustainability of that.
Before I bring Dan in, the drive into passive, is it in your head all the pursuit around the fee management? Is it just that I just don't want to pay any fees, I'm just going to go into this passive and I've got an idea that I want to, you know, buy this, whatever this may be? Yeah,
look, I'd probably characterise it in two ways. There's a chunk of it which is very clearly just driven by fees, and ultimately the decision on active versus passive is really just one about how much do I want to pay, and what's the, you know, do I want to pay a little bit for no potential alpha, or do I want to pay a bit more? And the question is, how much is that bit more for what level of alpha? But I think the other part of what we're seeing in passive, and it's probably more prevalent in the US at the moment than in Australia, is the number of different access vehicles that investors now have to get a passive return in some subsector of the market. And watching all the flows going into those vehicles is starting to cause, you know, in our view, some distortion in the underlying stock. So you look at the number of ETFs out there, for instance, that have Amazon or Google or Apple embedded in them, and it's most of the ETFs in some form or another. They're appearing in everything. So when you
they can recharacterise Amazon as something, like it could be a growth stock, it could be a...
I don't think you can make it a value stock, but you can make it just about anything else. And what happens is, though, as people sort of buy these subsector ETFs, you know, the overweighting that goes into those couple of, particularly those top 10 US stocks, keeps on just driving their performance up. And at some point, that'll all unwind and it'll go the other way. So I think there's some underlying embedded risk you've got to be a little bit careful in that passive space with.
Dan, welcome. How are things at Innova?
Good.
You want to walk through for the viewers that are new to the show about who you are and what Innova is, and a little bit in terms of your thoughts around what Greg's talking, the embedded risk. And for the viewers at home, we're not making a decision on whether you should or should not be in these sorts of assets. We're not saying that. We're saying, how do we start to think about those sorts of assets when markets are teetering at dizzy heights? So Innova, who are they?
We're an asset allocation shop that runs portfolios on behalf of clients. We deal via advisors, so if a client wanted to invest in our portfolios, they need to invest via a financial advisor. We put portfolios together with a particular focus on risk management. We think that's the most appropriate way for a goals-based portfolio to be put together, because there's a lot more to achieving goals than just, you know, getting a return. And if clients can be confident that we're investing their money appropriately and managing the risk appropriately to maximise that return, you know, they can focus on all the other things that need to go along with that: cash flow management, tax management, etc., etc. We implement that in a number of different ways, but predominantly via a managed account structure, and that's taking off right now. So, you know, business is good. There's a lot of potential business and a lot of interest in what it is that we do.
The strategic asset allocation strategy, I'm conservative I'm growth or whatever it might be, is not something that you adhere to. You think that doesn't make a lot of sense. Can you help the viewers who are actually probably doing that, so they're following that lead of whatever that advisor might be saying, why you don't think that's the way to think about it?
Yeah, we've got portfolios that adhere to that, but we're slowly moving people to a more risk focused approach. I mean, if you think about it very simply, if a client goes and sees an advisor and fills out a profile that says, I can tolerate X amount of risk, at the end of that, instead of putting the client into a portfolio where the manager is trying to manage portfolios to that risk target and therefore giving them the risk outcome that they've just said that they can tolerate, instead they put them in a fixed asset allocation result and they get a variable risk result, which is the opposite of what they just said they wanted. So it's the antithesis of what they needed. So what we're saying is no, instead of fixing the asset allocation, so strategic asset allocation, and allowing the risk to vary, why don't we try to run to a relatively static risk target and allow the asset allocation to vary? So as prices move and as risk attached to assets changes, we'll change the makeup in your portfolio so that we think you're taking the appropriate amount of risk, given the amount of risk that we determine up front you should be taking. You know, with the obvious underlying mantra that we want to maximise return, but don't ever take more risk than what was laid out to begin with.
Cool. You talked about the flows that we're seeing in ETFs and the various providers in the world. How are the flows with you? What are you seeing? What's coming into your portfolio of different managers? What's the
probably the hotspot really for us has been a strategy quite similar to what Dan's been talking about. So we've been running those what we would call objective-based strategies for nearly 10 years now, and you know, something called the Schroeder Real Return Fund, or it's an active ETF that we listed just over 12 months ago called Grow. And the idea behind that is to say, look, you don't necessarily want to own markets at any price, which is what a traditional balance fund does for you, or a typical kind of static asset allocation. It says, I don't care what the underlying valuation of the markets are. If I put $100 in, it's going to get split in this way. Our view was that actually, you know what, forward-looking returns vary through time, and when valuations are expensive, you don't want to own things, and when valuations are cheap, you know, you want to own a lot of them. So, you know, we launched the Real Return Fund and Grow, that broad stream of strategies back in 2008, and that's, you know, seen really solid flows, I think, as people have started to realise. Pretty solid flows still coming through at the moment. And I think actually, if anything, now is an even more important time for that. When you're seeing valuations as stretched as they are, you want to be real careful following a traditional, you know, strategic asset allocation that's applying, the bulk of your money to fairly overpriced assets. So having that flexibility to be able to pull back out of those markets to us is really important at this point in the cycle.
We've got a new Fed chairman. Is that the conundrum that he might be having? Jay Powell's the new Fed chairman. He will take over in February, I think. He'll be looking at where asset prices are and say, I need the music to continue on. The musical chairs has to continue on. Can you help people understand how you think he might be thinking around the economy, the asset prices, and then the political, let's go to 9% tax? Like, how do you think he would be pondering an idea around this?
So look, it's probably a job that none of us would really want, I think, because Janet Yellen's actually had a pretty good run. She managed to inherit the policies of Ben Bernanke. She hasn't really had to deal with a crisis during her tenure. Inflation has been very benign. They've managed to continue the whole QE, and nothing's really blown up. Asset prices have continued ever higher. At some point, that game has to come to an end, and we would be sort of, I guess, more confident that it's going to come to an end during the reign of Jerome Powell's reign, rather than the couple of months left of Janet Yellen. So I think he could face quite a number of challenges during his time. Our view is, for one, inflation is likely to start to pick back up again in the US through the back end of next year. The volatility in inflation has disappeared as oil prices have been a lot more stable. But when you look at what's going on in terms of the unemployment rates coming down, when you look at sort of capacity capacity utilisation, those sorts of things, then our view is that you could see a tick up in inflation in the back end of the year. So that core CPI number that the Fed's been so concerned about. And what's really interesting, if you look back to a period like the 1960s and you say, well, as unemployment came down, inflation was relatively stable, but then all of a sudden, once unemployment fell below a certain threshold, inflation took off, and we're right on the cusp of that.
When you think about that, we've got 3 minutes to go. Think about the fact that the GFC has taught management one thing, and that was how to say you can work for less and you don't need to work. And so they've been able to create this non-productivity, non-investing in businesses strategy. Are you of the same view? J-POW will have some challenges when the workers revolt, when they say it's full employment, it's now my time?
I think there's no question. We're already at, I mean, if you talk to people in the States, you talk to management in the States, there's no trouble finding low-skilled workers, but skilled workers is very, very hard to find at the moment, and that tells me that the wage price inflation surely has to come through at some point, because people are at the point now that are like, if I don't get paid enough, I'm going to move on somewhere. So yeah, J-POW is going to have a tough time. Have businesses learnt how to tell people no, you can take pay cuts? Yeah, they probably have, but does that mean people remember 2008? Well, have a look at asset prices. Clearly they don't, because they're willing to pay 31 times cyclically adjusted price earnings for the S&P 500, which we can talk about later. So people have very short memories.
But it is something that you're starting to worry about in terms of the way inflation plays in when you look at
I do.
this?
Yeah, absolutely.
You price how many different assets?
It was 172 last time I spoke to you. It's 185 now, and I sent 9 through to my quant analyst this morning that I want by next Monday.
Right. So are you worried about inflation?
Inflation, I think, is the big unknown out there that scares me the most, particularly when Janet Yellen's last speech essentially said, I don't understand why inflation is acting the way it is, and Janet Yellen's in charge of the biggest central bank in the world.
We're going to try and be a really positive show for the next 3 pieces. So, look, we'll go to our first break. I'll give them a bit of a slap around and say, look, it's a happy Friday. We'll talk to you soon.
All right, we'll cheer up.
You're watching Your Money, Your Call on Sky News Business.
How hard is it to find a home loan online? Sifting through so many different rates, what loans do you even qualify for? It seems impossible until now. Lendy does the hard work for you, instantly comparing thousands of home loan products from over 30 Australian banks and lenders to find the right home loan for you. No lining up at the bank or applying for the wrong loan. Compare, choose and complete online the easy way with lendy.com.au. Lendy, your home for home loans.
By introducing new laws, the Australian government has now closed a number of multinational tax loopholes and has also established the Tax Avoidance Task Force. In fact, since July last year, ATO Action has already collected over $1.5 billion from large multinational corporations. This means more money is being invested in Australia, because if it's earned here, it should be taxed here. Find out more at fairtax.gov.au. Authorised by the Australian Government, Canberra.
Scenic's luxury sale means luxury for everyone. Book any suite on selected truly all-inclusive luxury Europe river cruises and you'll fly free. Hurry, see your Scenic agent or call 138 128 today.
Jamie, you can't cool down with that. Keep it real.
Get 50% extra free. New $1 jumbo, only at Hungry Jack's.
Register today at Elite Singles, where you'll benefit from 100% verified profiles, an extensive personality test and tailored matches in your area. elitesingles.com.au. Never more ready to fall in love again.
Buying the perfect property can be a real challenge. You can spend months looking around only for the home you find to be bought by someone else. That's why I founded property buyers agency Cohen Handler, to empower the buyer to own the home of their dreams. With hundreds of successful purchases, we take the stress and long hours out of trying to buy a new home by guiding, negotiating, and purchasing your property. Simply call Cohen Handler today and tell us what you want in a property, and let us show you everything that exists in the marketplace, based on your criteria, including location, price, and potential growth.
Thanks to Cohen Handler, we were able to find the perfect home for our family to grow into.
We met with Cohen Handler in late January, and by April we had purchased a property.
There's nothing to lose. Save time and money. Get the experts from Cohen Handler on your side and find your perfect property today. Go online now at cohenhandler.com.au or call 1300 420 160 and get the right property at the right price.
With armed conflict in North Korea a real possibility, where does Australia stand? If Washington and Pyongyang go to war, should Australia's military get involved? Hear the arguments and have your say. That's Politics HQ, Sky News Live.
Now, back with Your Money, Your Call.
Welcome back to Your Money, Your Call. I'm Mark Todd from the NAB. I'm joined by Dan Miles from Innova Asset Management. Greg Cooper is the CEO of Schroders. I've had a CERN talking to him. They said, no, it's going to get ugly for a while. Call us, 1300 30 34 35. The email is yourmoney@skynews.com.au. We have to get it down low before we can bring it back hard. That's the plan. We're going to try and end on a positive note. We're going to start with US valuations, and we have a chart that Dan will talk to, and it'll talk about what he thinks the US is happening in terms of the valuations in the US right now. And so that chart will come up any minute now. But when it comes up, you're going to say things aren't as hot as you'd like it to be.
Well,
or it's too hot.
It's too hot. They're not cheap. I mean, this goes back to 1881. This is look. There's lots of different ways you can value a market. This is a very popular way, popularised by Robert Shiller, the Nobel laureate, called the cyclically adjusted price-earnings ratio, or the Shiller ratio, where you take last 10 years average earnings. And the reason why you take 10 years is you can take out the business cycle, and so therefore you average it out, and price compared to that. We're at a point now that we've only seen twice before in history. Once was prior to the Great Depression, and the other was the tech bubble. You know, we're well above the GFC highs, and we're well above where we were in 1966 prior to the inflationary spike. So, look, that doesn't mean that there's an imminent crash. So don't get me wrong, and it also doesn't mean these things can't get higher. I mean, in Japan, they got up to a cape of 94 in 1989, so things can get absolutely insane, but it does mean... So
this is a cape of, what, 32 or something?
31, just over 31. Yep. What it does mean, though, is that the likelihood that you're going to get a really good return over the next 10 years out of the US market, just for broad-based passive investment in the US market, is pretty low. The probability is pretty low that you're going to get a decent return. But that's just the US market. Like, the US is expensive, but not everywhere in the world is expensive.
Sure. But I just wanted to bring Greg in, because I think a lot of people think about when you see investments going outside of Australia, it goes to the US market. That becomes the key. So the US plays two different strategies. One, it's the Fed funds, is where we set our term deposit rates. The other is it's the big animal in the room. So if it's going well, you know, the rest of the economies can sort of play off it. How do you think the US market right now from a valuation perspective?
Well, we're in a very similar boat to Dan. I mean, it's you know, if you think about it in terms of, you know, where have returns come from over the last 10 years, then about half of the total return you've seen in the US market has come from just a revaluation of the market. You compare that to Australia, where only about 10% of the total return you've seen in Aussie stocks has come from valuations actually
multiple expansion.
So multiple expansion, that's right. So, you know, our view is, if you're going to, the problem with valuation as a measure of, or as a way of investing, is that you kind of got to shut your eyes and wait for 3 or 4 years for it to play out, because it's not a great short-term measure, but it's a really good long-term one. So our view is, look, you know, the US is unlikely to give you much of a return over the next 3 to 4 years, or looking out to, you know, 10 years basically. But there are other markets that are. Aussie looks good. Probably the one thing I would say about, you know, the markets, and this is markets everywhere around the world, but it's particularly prevalent in the US, is you also got to look at the composition of that. Where's that, you know, that high cape coming from? And our view is there's an awful lot of concentration in a small number of stocks which have gone stratospheric, and actually there is still some decent value out there if you're prepared to sort of, you know, broaden your horizon and go in for a much more diversified portfolio.
So it's the FANGs. It's
the FANGs are,
it's
yeah,
all
that's
that.
right.
So it's
yeah,
the
you know,
things that are driving it forward.
Yeah, and you look at, you know, stocks like Amazon, and, you know, there's a lot of talk and so forth about how they're going to take over the retail space globally and etc. But all that's priced into the stock. You know, this is something that trades at 200 times earnings. You know, it doesn't actually make a lot of money. It does make some, but not very much. So, you know, you're really betting on a very, very rosy outlook continuing. So, you know, our view is, look, you know, if you start to look beyond some of those FANGs, there is, you know, the valuation sort of, yeah, they're still high, but they're not as bad as they are at that real upper.
So where do you see value at the moment?
Aussie is one area we would see some value. Aussie equities, they're our best returning. When we look out, we sort of do a range of forecast returns across a whole range of different markets, but across equities and bonds. And Aussie is our standout market in terms of expected return at the moment. So again, if you closed your eyes and sort of came back in 3 or 4 years, we think Aussie is much more likely, of all the equity markets around the world, Aussie is probably the one that's going to give you the better return.
Right.
High grade corporate bonds, there's still, hard to say there's lots of value there, but we still think there's a reasonable
NAB
return.
issued a 5.25-year bond today. They had billions of bids. They issued $2 billion. It was done in 2 days at about 80 over the swap rate. It was quite amazing the amount of interest. So Boral came to market last week. $950 billion made up of 2 tranches, a 5-year and a 10-year. They had $7 billion in bids. So for the viewers at home, what that means is Boral says, I want to borrow $1 billion. That's all great. That's a lot of money. It is investment grade, but only just. It's just triple B flat. The amount of money it received was $7 billion. They say, I only want $1 billion. Wow, they were knocked over in the rush.
I'm glad Greg came on and said it, because every time I come on here I say I don't mind investment grade corporate debt here in Australia, and finally someone else has said it as well, so someone agrees with me.
Yeah, look, I mean, clearly what you're seeing is, and it's evident in those returns, those flows, is just there's so much liquidity floating around, and people are just looking for anything that's going to give them a bit of extra return.
And viewers, you have a lot of cash. We'll talk about that, but we want to talk about what Dan thinks is good value. So we've got another chart. There's an Aussie, hopefully we'll bring that up, AUS CAP 10. Yep. So that's the Aussie market. So if the Aussie market is at 20, or under 20, slightly under
19.
19. The US was at 31, slightly over 31, 32. You're saying on a relative value basis, that looks like it's quite good. It's on the same thematic. It's earnings versus price over the 10-year cycle. That looks like it's interesting.
Yeah, that's right.
So we could buy an index there?
Yeah, well, you could buy a portfolio in Australia. I tend to agree with Greg. So, he's pointed it out and said that, in Schroders' forecast, they like Australia. This is one of the reasons why they like Australia. It's not outrageously expensive. The underlying growth profile is fine, and you're not overpaying for it. It's not outright cheap, but it's not expensive by any measure. You could use price to book, price to sales, whatever you want. None of those, it's expensive.
So the other chart that we've got is Europe CAPE 10. So that's much cheaper, but on the basis of very low base, on the idea that it's coming from a low base. So I think we can try and bring Europe. And so Europe is at 19.
Yeah, Europe's a really interesting one from my point of view, because you've got a scenario where you've got some really amazing business names, the same way as you do in the States.
Yep.
You've got relatively strong economic growth that everybody thought would be really poor. The UK came out, surprised everybody again. But you've got incredibly incredibly loose monetary policy, whereas over in the States we're trading at 31 times Schiller PE in a tightening monetary.
This is it.
Tightening cycle, that's at about 1920 for Europe, but you've got really loose monetary policy, and the underlying GDP growth is not quite as strong as the US, but it is still quite strong. Right. So, in a relative basis, I much prefer European equities to US equities. I much prefer Australian equities. I don't mind emerging market and in particular Asian equities, with just cognizant of the fact that if there is a sell-off in the US, doesn't matter how cheap they are, they can unfortunately just get sold off really badly as well as...
what's your attitude towards Europe? Is it something... Is this the story of ETFs? Is this where you say, look, I wouldn't mind... Because it's very hard to work out what's good in Europe. It's because you're not there yet.
Yeah, look, we would still go for individual stock selection across all markets, because we think that's the best way to, particularly in an environment where valuations have been sort of moving up. And let's not forget, while we talk about some markets being cheaper than others, if there's a big correction, markets all tend to correlate during that. So again, the point about valuations is it's really just saying, if I shut my eyes and came back in 3 or 5 years, I think I'm going to get a much better return out of the likes of Europe and Australia Australia than I'm going to get out of the US. But in the meantime, there can be an awful lot of volatility that plays out through that. So, you know, our view would be actually you do have to say you're pretty cognizant of what you want to buy within those. You know, clearly we're an active house, so that's you know, and we've made good money in active management on behalf of the clients. So
how would you characterise risk appetites at the moment? How would you think, talking to people, let's buy Europe, we look at all this data, everyone gets told you don't have enough US exposure and all that sort of stuff. How would you characterise the flows you're seeing from the clientele? What's their view towards risk right now?
Yeah, look, the risk appetites are high, is what I would say, and you see that in, you know, I would call it more complacency is extremely high. Yeah. You know, we run a global business and we look at flows across the you know, we've got a very big business in the UK and Europe, being you know, a UK asset management house, and the flows that are coming through out of Europe, but particularly into, you know, corporate bonds and lower grade credit issues has just been enormous. So there's a lot of money out there trying to buy yield, and you know, there's not much money sitting on the sidelines, and I think everyone's basically saying let's just buy, and you see it in, you know, you see it in volatility. Volatility is really depressed at the moment. People just don't see much risk out there.
Folks, we'll take a short break because they're starting to worry me. I need a cup of tea. We'll answer any questions. Feel free to call us 1300 30 34 35. Talk to you soon.
You're watching Your Money, Your Call on Australia's Business Channel.
With AINet's limitless broadband data, there's no end to what you can watch, stream, or download. And it's just $69.99 a month on a no lock-in contract! Release your internet's potential with AINet, the #1 in customer service.
Pharmacy for Less is the new discount chemist in town that guarantees to beat any price. With savings across all leading brands, see why Pharmacy for Less is one of Australia's fastest growing pharmacy chains.
Bloom's Green Lips Mussel and Turmeric, only $19.99. Bloom's Magnesium Powder, 200 grams, now $12.99. Bloom's Vitamin D3, 400 capsules, a low $16.99.
Professional care, service and unbeatable prices. Pharmacy for Less. More care for less cost.
Under old laws, some multinationals would use loopholes to avoid paying tax. So from the 1st of July 2017, large multinational corporations that move undeclared profits overseas can be penalised with a tax of 40%. As a result, more money is being invested here, benefiting Australian communities and the economy. Because if it's earned here, it should be taxed here. Find out more at fairtax.gov.au. Authorised by the Australian Government, Canberra.
Register today at Elite Singles, where you'll benefit from 100% verified profiles, an extensive personality test and tailored matches in your area. elitesingles.com.au. Never more ready to fall in love again.
Jamie, you can't cool down with that. Keep it real.
Get 50% extra free. New $1 jumbo, only at Hungry Jack's.
Same hotel, same price? Oh, no. There are so many different prices out there all over the internet. And Trivago instantly compares them all to find your ideal hotel for the best price. Hotel Trivago.
QuickBooks introduces Jeanette and her mobile wedding business. She travels far and wide to celebrate I-dos and uses QuickBooks Self-Employed to automatically track her mileage. She categorises trips with a swipe and is ready for tax time. Save 50% at quickbooks.com.au.
Here's to the guys who won't put up with only 28 days of prepaid. And to the girls who've cut the telcos that cut them short. Leave the rest behind and switch to 35 days expiry on Vodafone's prepaid $40 and over combos. You get 35 gig of bonus data over 10 recharges. That's an extra 3.5 gig per recharge. Switch to Vodafone today.
Now, back with Your Money, Your Call.
Welcome back to Your Money, Your Call. I'm Mark Todd. If you want to email me directly, it's mark.todd@nab.com.au. I'm joined by Diane Miles from Innova Asset Management. Greg Cooper. He's from Schroders. He's the CEO of Schroders. They'll answer any of your questions. 1300 30 34 35. The email is yourmoney@skynews.com.au. Through the course of this show, we'll have a couple of quick emails, but we wanted to find out what risk appetite is coming through with your clients. What are they saying?
I'm getting very similar phone calls to 2005 and 2006.
Okay.
Where it's all about return, irrespective of risk. I think Greg described it the best. People refer to the VIX as the fear and greed index. I think it's probably better described as the fear and complacency index, as Greg described your complacency before. I think there's a lot of complacency in the market, so I think that the fear of missing out is really starting to hit home at the moment.
Yeah, here's a great stat for you, actually. So the VIX has closed below 10 about 40 times in the last 30 years. 30 of those times are this year.
Prior to July, it had closed about 4 times in 20-odd years, and then in July it spent 2 weeks below 10, and it was staggering. So
do you want to explain to everyone what the VIX is?
You go.
Me? Okay. Yeah. So the VIX is a measure that the Chicago Board of Options Exchange uses as a measure of implied volatility. So it takes the option pricing of options over the S&P 500 and uses it as a measure of implied volatility based on the prices of those options.
So if they only go up and they don't go down, VIX goes lower?
If there's not a whole lot of movement in the market, the VIX stays low. And there's almost an unwritten rule that the VIX doesn't go below 10. At least there was an unwritten rule that the VIX generally doesn't go below 10 prior to about June of this year.
This has been a lot of rewriting of rules. One thing that's happened is that the US have produced an awful lot of jobs. So non-farm payrolls tonight will be something, we imagine, with a 300 handle. And that will push the Fed into a tightening bias in December. So I think everyone sort of imagines that is going to happen. So the question for you guys is, I'll start with you because you just spoke. Is 2018 the key to 2018, the tightening bias, how it actually plays out in markets? Is that the key to this?
Well, I think you've already got the tightening bias, like the Fed's already come out and said, you know, we've started to bake in some rate rises. You're seeing lessening of QE coming through in other markets. You know, the UK's already starting to raise rates. So I think the tightening bias is there. The question is how much, like how far does it go? And I think that's where, again, the key comes back to things like inflation. You know, and if you're seeing a reasonable recovery, which you are at the moment, I mean, global growth is ticking along reasonably well. Unemployment's falling.
So that should make equities good.
It should, except, you know, for the fact that if rates start to rise, then, you know, if people have largely bought equities on the basis that, you know, rates have been falling, discounted cash flow makes the, you know, I'm happy to take a lower future return from equities because rates are low. If rates starts to rise, and certainly the history shows you when rates rise, you know, equities can get hurt. So
Dan, if that's right, do you think 2018 is about the pace of the hike, like the arc at which they lift rates, rather than it's been baked in? There has been a dramatic disconnect between what the Fed thought they'd do and what they're actually doing. So once a year they'll do a rate hike. They would have thought there was 4 this year. There wasn't. So is the key to it the speed at which they hike, not the fact that they'll be hiking?
Yeah, it could be, and that will all be determined by what happens on the inflation front. I actually think the key over the next year will be policies. I mean, we've seen Trump's proposed tax policy. We also need to see his immigration policy, and we also need to see his foreign trade policy. So the tightening cycle is going to be very interesting. If that plays out in a fairly benign environment, GDP growth comes through and the rate hikes are fairly moderate and swallowed by the market, I don't think we're going to see any hiccups. But if tax policy doesn't get through, they do something silly in regards to immigration or foreign policy, that could cause some serious hiccups. So.
Yeah, these things are all about what's relative to market expectations. Yeah. Market expectations at the moment are pretty benign.
What about the fact that, you know, what Dan's talking about in terms of Trump and the execution risk at a political level, and think broadly into Brexit and what's happened? How do you think, as a corporate citizen, people can start to think about, my idea in my head is that companies want certainty. And so they therefore act on the basis of certainty. So if the tax plan doesn't go through, what do companies do? If Brexit can't give you a decision, they start to look for where there's decisions. They might all go to Europe. They might, you know. How do you think the viewers here should be positioned when they think about that sort of stuff?
Yeah, this is one of the greatest disconnects that you see in markets at the moment is, you know, if you had to draw a chart, and there are indices out there that have been created to show what does economic policy uncertainty look like. You know, economic policy uncertainty is about as high as it's ever been. Yeah. Yet, again, the complacency that's evident in markets is
out of Australia, we don't have an energy policy, so how do you play into the energy stocks?
And the fact that all these things are prone to sort of fairly significant changes looking ahead, I think actually means that there's a lot more risk out there in terms of that economic policy environment, and you know, markets, that could be one of the things that upsets markets in the near term.
So how should investors be positioned? Try to give them a positive story, because
no
one's ringing because they're all, you know, slitting their wrists.
No, I think there's some relatively common sense things that people do, and I think there's really just two they need to follow. We talked about it earlier about investing in steer clear of the really expensive markets and stay invested in those that are not overly expensive, because you have no idea what's going to happen in the future. Until somebody invents a time machine or a perfect, you know, crystal ball, nobody can predict the future, right? So if you need to be invested, just don't be invested in the really expensive stuff. Find the stuff that looks reasonably attractive, and we've just outlined a number of them here today. And when there's lots of uncertainty out there, diversify a little bit more than you probably would normally, and then when there's not so much uncertainty and you're quite certain about the result, that's when you can concentrate those positions into the really attractive things that come across your desk.
Where should they go?
Yeah, look, there's that, you know, that statement that we always have to make, and it's on at the beginning of the show.
We don't know what you're doing. Like, you know,
past performance is no guide to future performance, and I would say that is very, very evident at the moment. If something's showing a really high return historically, then it's likely because they've taken quite a lot of risk to get there, and that's not necessarily going to pay you off going forward. So our view would be, look, just temper your expectations. Yeah, there is still bits of value that are out there in market. You don't have to go entirely to cash. Holding a bit of cash is not such a bad thing, because that gives you a free option when markets do correct, and you can move quite quickly in that case. And that's certainly what we do within, you know, vehicles like Grow and the Real Return Fund, is hold on to some of that cash and be ready to put it to work. But there's a bit of value in Aussie equities, corporate grade bonds. Just the main thing is don't chase it. Just prepared to sort of lower your expectations.
So when somebody talks to people here will read interest rates are going higher, don't buy bonds. You've just said we're going to a tightening bias, but there's some corporate bonds. Can you help people understand the fact that you don't have to avoid bonds at all costs because there's something that's aligned to the higher rates?
Yeah, it's certainly not. I mean, the question as to whether you make money or lose money in bonds really is a function of the yield that exists on those bonds and the coupon payment that you're getting relative to how long the duration is. So if you've got a really long duration bond and interest rates tick up, then you're going to lose some money because a lot of your money is back end loaded and gets discounted at a higher rate. But there's still, you know, if you own at the short end of the curve or you've got relatively short duration in your bond portfolio, then that ticking up, if there's a slow gradual rise in interest rates, the additional yield that you're picking up from either a bit of credit or just being out the curve slightly will more than compensate you for the little bit of capital loss that comes through. Yeah. So you'll get a better return than you'll get from just holding pure cash.
And you're okay with corporate bonds at the right price?
Yeah, absolutely. I put a chart about the floating rate note index on the show once before, because that's a place that people can have a look if they're worried about a tightening bias. You know, A-grade corporate credit in Australia, you're getting a 50 to 80 basis point premium above cash. You know, that's reasonably attractive from where I'm looking. Yeah, and
we'll take a couple of emails. We have an email from Gary. Gary is asking about PIMCO. He says, I'm looking at PIMCO Capital Securities Fund and Income Fund. Do you have any views on it? And what do you think of the recent Suncorp hybrid? Now, bearing in mind we don't give specific directions on any advice. You know, we're not on an advice basis, but you had a look at PIMCO. What did you think?
Look, I want to make a comment on... look, PIMCO as a manager, I think they're more than capable of what they do.
Could you help him tease out what was in it?
Yeah.
You looked at what was in the...
So let's have a look at the two different funds. So one is the PIMCO Capital Securities Fund. It predominantly owns European and US versions of hybrids here in Australia. So therefore it's a long way down the capital stack, except the difference is that most of those instruments are fixed rate, they're not floating rate. So Greg referred to before duration. There's going to be duration risk in that portfolio. The returns in the last 12 months from that portfolio would have done extremely well because everybody in Europe has, it's almost like yield locusts. Anything that had anything like yield, they've just swarmed to and swallowed. So
it's performed well on the basis that everyone's in, rates are low, trying to find something.
And swallowed it.
And PIMCO might know a little bit about hybrids, so that's not, we're not saying no, we're saying you're buying a hybrid model. That's okay.
That's
as
fine.
long as the manager knows what they're doing, we're not saying don't do it.
Yeah, and they do know what they're doing, but what it does mean is that a lot of the return that would have come through from that would have been a capital gain from people swallowing up that, because there's no way that the yield on offer was anywhere near what was in that return. So that's been a capital gain component.
So it's not the cash flow, it's the valuation difference.
Yeah, correct. So I wouldn't expect that sort of level going forward because there's not that many places around the world offering that. The other fund, the income fund, that has a fairly large allocation to high yield bonds, and you could Google high yield bond option adjusted spread. The Federal Reserve. Yeah, it spits out a chart. You can have a look at the spread over treasuries. It's about 3.5–4%, which is very low, which means you're only getting a very small premium above treasuries for sub-investment grade, i.e. junk bonds. But the reason why that spread has come down is because people have bid up the price, which means the future return from them is much lower. Right. Future expected return is much lower. That doesn't mean don't buy them.
He's saying that you've missed maybe the rally, and it's a question of whether they will rally further, and then you have to back the manager. So we're not saying don't do it. We're just saying, does it rally further? And is that the right manager? PIMCO know their stuff. You've got to make a question on whether that rallies further, or can you replicate that yourself? What do you think of hybrids? I want to ask what you think about PIMCO, because I know you think they're good guys and they think you're good guys. We're all a loving family in the financial markets.
Yeah, look, I mean, our view on hybrids has been probably a little bit more benign. We were one of the biggest buyers of hybrids if you go back certainly 10, 12 years ago. And we've tempered that view largely because the issuance has died away. Some of the, relative to where we were, then don't quite offer the yield pickup that you used to. Hybrids used to be great and that you'd get an additional yield in a hybrid that you wouldn't necessarily get in the corporate bond market. Our view now is a lot of that's kind of evened its way out. And in fact, if anything, when you're looking at a hybrid, it's good to look at what are the other alternatives. So, the Suncorp one's an interesting one that's just come out. It's probably going to price at the bottom end of the range. What else could I buy at that same yield is an important question. And, look at, the ANZ hybrid's got very similar yield and is a slightly different credit quality. So I think some of those are some of the things you've got to look at.
So one of the things to think about with that one, Tim, is the fact that Suncorp will be hard to access. So it was a roll. In other words, they had a security. They've decided to redeem that security. They'll offer you another security. That roll was probably at the 50% level. There was a lot of people trying to buy the balance. It's not a big issue. So NAB will go out with a $1.2 billion issue in hybrids. So you could probably find some of that. This is, I think it's a $250 million issue. So it's not a massive issue. Half of it has already been pre-pledged because the client's had it. And NAB is on this. So the client had a Suncorp. He said, look, I'll exchange one for another. It makes it very hard to access it. So Greg's talking about look at the broader market in hybrids and just make a decision. Suncorp borrowing money, ANZ borrowing money. What return do you get? Don't think of the capital price. Think of the trading margin and then think of the cash flow. So that's why. And I'm not saying anything's bad. I'm just making the point. Let's do a little bit more due diligence.
Can I just add a point on bonds generally, actually? I mean, bonds are a hard one for individual investors to access because generally they have to go out and buy a couple of hybrids because they're generally using a listed portal in which to do that. So I would just advise people to have a think about, broader tools that they can use, whether it's managed funds, whether it's some of the ETF vehicles, which come with a few other issues. But think about trying to get a bit more sort of diversification into your bond portfolio rather than necessarily just, jumping on one particular issue. I mean, pretty much any bond fund you buy out there is going to have a much more diversified portfolio than any individual investor can realistically build themselves.
And I'll tell you, to put it in context, for an individual, for somebody who's running a self-managed super fund, are they going to be able to price a perpetual subordinated unsecured convertible that has discretionary distributions that are non-cumulative?
We are literally going to go to an ad break, but one of the things you can do before we go to an ad break is look up M funds. You can go to NAB Trade and you can look up M funds and you can have a whole array of fund managers.
There's lots of ways.
And you can buy that for $1,000. But everyone calm down. We're going to come back with a very positive break because we're going to talk about bitcoins. That's excitement. So we'll go to an ad break and we'll come back and chat about the bitcoins. We'll talk to you soon.
You're watching Your Money, Your Call on Sky News Business.
Pharmacy for Less is the new discount chemist in town that guarantees to beat any price. With savings across all leading brands, see why Pharmacy for Less is one of Australia's fastest growing pharmacy chains.
Bloom's Green Lips Mussel and Turmeric, only $19.99. Bloom's Magnesium Powder, 200 grams, now $12.99. Bloom's Vitamin D3, 400 capsules, a low $16.99.
Professional care, service and unbeatable prices. Pharmacy for Less. More care for less cost.
It's a Friday night, a Season 5 invite, and candlelight. To homemade tacos, BYOs, and happy Sunday arvos. Here's to you.
Register today at Elite Singles, where you'll benefit from 100% verified profiles, an extensive personality test and tailored matches in your area. elitesingles.com.au. Never more ready to fall in love again.
Vita-Wheat whole grains and flavour. Together at last. New Vita-Wheat cracker chips. Whole grains and flavour. Together at last. There is no substitute.
Here's to the guys who won't put up with only 28 days of prepaid. And to the girls who've cut the telcos that cut them short. Leave the rest behind and switch to 35 days expiry on Vodafone's prepaid $40 and over combos. You get 35 gig of bonus data over 10 recharges. That's an extra 3.5 gig per recharge. Switch to Vodafone today.
Buying the perfect property can be a real challenge. You can spend months looking around only for the home you find to be bought by someone else. That's why I founded property buyers agency Cohen Handler, to empower the buyer to own the home of their dreams. With hundreds of successful purchases, we take the stress and long hours out of trying to buy a new home by guiding, negotiating, and purchasing your property. Simply call Cohen Handler today and tell us what you want in a property, and let us show you everything that exists in the marketplace, based on your criteria, including location, price, and potential growth.
Thanks to Cohen Handler, we were able to find the perfect home for our family to grow into.
We met with Cohen Handler in late January, and by April we had purchased a property.
There's nothing to lose. Save time and money. Get the experts from Cohen Handler on your side and find your perfect property today. Go online now at cohenhandler.com.au or call 1300 420 160 and get the right property at the right price.
Jamie, you can't cool down with that. Keep it real.
Get 50% extra free. New $1 jumbo, only at Hungry Jack's.
Now, back with Your Money, Your Call.
Welcome back to Your Money, Your Call. I'm Mark Todd from the NAB. I'm joined by Dan Miles from Innova Asset Management, Greg Cooper from Shoulders. They're here to answer any questions, but we've only got about 8 minutes, so be quick. 1300 30 34 35. We have an email from Barry. Now, this is a couple of weeks old because we had the problems with the show set not being ready. So the email from Barry is, I've been listening to all your podcasts and still love the format and the education in your show. My question is, how do I go short on Bitcoin? I love Barry. I'm bullish on distributed ledger as a technology, but Bitcoin just shows how not to implement it. The computation to mine coins has become huge and creating the supply-demand bottleneck, not to mention the carbon emissions from the electricity to mine them and the manufacture of them, the mining equipment. The NTA is zero, even worse than tulips. Their only advantage is they allow people to participate in the black market, something that governments are and will push back against. Keep up the good work. Right. How do you get short Bitcoin? I've just been told that it hit $9,000 today.
9,000 Aussie dollars.
How do you get short Bitcoin?
I don't know how to borrow it, so I'm not sure you can go short Bitcoin. If you can find a way to borrow it, you could lend it out, I guess, but I don't actually know of a facilitation mechanism. But if I firmly believe that Bitcoin was going to go bust, I probably wouldn't short it anyway because of the amount of volatility in it, because irrespective of if it did go bust, you have no idea what what is going to happen between now and when it drops, and you could get completely taken out of your trade well before it actually goes to zero, because of the amount of volatility.
So yeah, the vol is that if it just keeps jumping overnight because it's thin, it could really hurt you. And I'll just think of the numbers with your Bitcoin wallet that you were talking for in a second. I just want to get at a corporate level. JP Morgan said we're not going to be invested with it. We're not, and then he came back and said, Jamie Dimon said, look, actually, I'm not going to talk about it anymore. Because obviously some of his staff said, hang on, we want to be here. Can I get my bonus in Bitcoin? Goldman's have tried to come out with a way of thinking about how to monetize and be involved with it. At a corporate level, what's your thoughts on Bitcoin? How do you see that as a potential asset? Like, do you just say, look,
we don't like all the cryptocurrencies. I wouldn't just single out Bitcoin. I mean, like any asset that you own, you've got to, it's got to have an underlying fundamental basis. And if it's a currency that you're going to own, how does that currency get its underlying fundamentals? Now, normal currencies, US dollars, Aussie dollars, are partly backed by governments and taxation revenues and all those sorts of things. So there's some underlying fundamental basis as to why they exist. These cryptocurrencies, there's no fundamental basis. It's just that they've just decided that two people want to exchange something and we'll put an arbitrary value on it, and then a third person jumps in, and so the price goes up by 50%.
It's the barter society gone mad.
It is the barter society, but it's a crazy barter. If you think that you're just holding that unit of exchange is the way to make money, I mean, the barter society will still go on. Can I swap you a $2,000 ferret for your sort of $3,000 tulip? It doesn't make any sense.
How do you get short it? Can you get short this market?
I don't think you can. To Dan's point, I don't think you can. There's no real.
Sorry, Barry. It's a very disappointing show at the moment. It's just bleak.
Yeah, but look, it's just you've got to be, when you short anything. I mean, bitcoins aside, you have to understand that the process of shorting, the path that something takes. You might be right on a particular time horizon, but it's the same as when you have leverage and you go long. If you buy something with leverage and the price of what you bought halves before it doubles, then you may get stopped out because the bank may say, I want my money back. Whoever's providing the leverage says, sorry, I need my money back.
Banks wouldn't do that.
Yeah. So, and it's the same with shorting. When you short something, if the price of that thing that you're shorting doubles before it goes to zero, you get stopped out and you lose a lot of money. You're right in the long term, but in the short term you get killed.
And there's been a couple of guys. I can't remember which was the Japanese shorter in one of the, like, it was one of the metal manufacturers. It was Mr. Short. He just kept shorting, and he went for his last short and it busted the market. I can't remember which one it was.
Oh, that was well, there was that. There was, yeah, that's right. That was, I think it was Sumitomo Mitsui.
Yeah, and it was like one of those things where you just think you just put everything to work to try and get this short working, and the risk was just massive at the
it's
end
like
of it.
Nick Leeson from Bearings. That was the same thing, basically.
That's right.
They just kept doubling up.
Can we have a little bit of positive? You've been talking about. Or do you want to tell the Bitcoin story about your wallet when you look back in your wallet?
Well, if you're interested. Well, to describe the volatility, I thought I'd set one up just to see what was going on and deposited some money. And by the time the blockchain had loaded, it took me about 2 weeks. It was the amount in the account was up already about 40%, so I used it to go and buy some stuff online. And then I had some residual amounts that I didn't look at for a month or something. I've come back and they're up 300%, and I've just kind of scratched my head and think, how many of the people who are actually buying this have actually read Satoshi Nakamoto's original paper on why the blockchain exists? I'd say 1 in 1,000 or 1 in 10,000 of the investors. So
this is just a momentum trade.
Yeah, of course it is.
Okay, so we've got a few minutes, 2, 3. What are the positives? Give everyone some positives.
Yeah, absolutely. Well, look, there's 45 regions that the OECD monitors in terms of GDP growth. This 2017 was the first time since 2007 that we've seen synchronised global growth across all 45 regions. On top of that, 33 of them are accelerating, and on top of that, which is an even better story, is the standard deviation between the growth, so how much variability is there across it, is the lowest. Like the records I saw back to 1971, 61, this is the lowest it's ever been. So it really is synchronised global economic growth.
The glass is half full, but it's getting fuller.
Well, it's a great thing, but the question always comes down to the price, right? So that's the point. So the economy's doing great, but you don't necessarily want to overpay for assets just because an economy's doing great. So don't buy the priced assets. That's our point. I'm not saying it's all doom and gloom. I'm just saying don't overpay for stuff.
Look, and there will be opportunities out there. I think the key thing is you've got to be prepared to be flexible. If you just put your money in a fixed, what we were talking about right at the start of the show, if you put your money in a fixed asset allocation, then every dollar you put in is buying that market irrespective of where it's valued. And I think what you want to do is make sure that you've got the flexibility, or you've appointed a manager with the flexibility to be able to take advantage of opportunities when they come. Because the opportunities will come. Markets are stretched. There's going to be more volatility out there. The Fed's got an interesting mandate, I think, over the next 12 to 18 months. That's going to throw up opportunities, and that's the point where you get excited. When assets, when something happens and assets get a bit cheaper, that's when you jump in. That's where you'll make your money.
Okay, so one of the things that volatility being low does is makes the insurance contracts cheaper on a relative historical basis.
That's right.
Would you ask people to start pricing and thinking about, if you can't hedge your portfolio forever because it's too expensive, maybe an event risk style hedging? So go to 3 or 4 or 5 months, whatever your period that you don't want to have any headaches. Would you ask them to start considering pricing options around protecting their equity exposure?
So we do a little bit of that. In our real return fund and the grow strategy, we take out some tail risk hedges, and there are different ways to do that. You do have to be a little bit careful with options and understand how they work, because the time decay can be quite strong. So you've got to get the timing right on it, or construct them in the right way. But a bit of tail risk hedging when insurance is cheap, it's not a bad thing. As I said, we do that within our multi-asset portfolio.
Don't get short, because Dan just showed me a chart that said you never want to get short. But that's all we have time for tonight. So I'd like to thank Dan Miles from Innova Asset Management, Greg Cooper from Schroders. And if you've missed any of the show and you'd care to listen to it and catch up on the program via a podcast, go to your favourite platform, search for Sky News, Your Money, Your Call, and we'll be there. Have a great Friday. Enjoy your weekend.
Information presented on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming.